Welcome into Mindset. I am Brad Barrett. Today we're going to be talking about how to reduce your taxable income for 2025 and frankly for every year. And I can't tell you, I'm so surprised every year that we get so focused on April 15th that everyone forgets about this date of December 31st. So we're going to talk about today. We're going to talk about how to reduce your taxable income. We're going to talk about tax loss harvesting, itemizing, and stay tuned because the last two I'm going to bring up have worked for nearly every single one of my clients. And as the old saying goes, remember, it's not always what you make, it's what you keep.
I learned a lot. I'm going to use a couple of these this year.
So I will say this as we get into this episode. I'm going to promise you out of the gate here and just be upfront with you. This probably and will get a little technical, okay? So as you watch through this, just follow through. I promise you it's important. Make sure everything I'm saying, though, you also want to just filter with your CPA. By no means are we legal or accountants here, but these are strategies that I use for our clients. But anytime you talk about taxes, gets a little numeric. Just watch their faces. They're going to glaze over, I'm
Numbers
sure.
are heavy. We might fall asleep, but keep talking, Brad.
Well, we're going to make it fun, I promise. All right.
Did you know, according to the IRS, the average tax refund in 2025 was over $3,000? So
The average.
important.
That's actually, I don't know if that's, wait, I'm trying to think if that surprises me or not.
I want more.
Well, yeah, it seems, on the whole, it seems low.
Yeah. Hopefully these tax tips will help us get more back, regardless of what you took out or put aside. This is for those bigger paydays.
So let's start with point number one on deferring your income. Okay, so people understand, right? Whatever income you're making for the year, you're going to get some adjustments, some tax deductibility, some credits on there. So right now, sitting in here in November, heading into December, let's talk about some of the ways we can do this before year end. And the first one I have to bring up because I know it's going to be super simple for many, but for some maybe not. You got to look at your retirement plans. You got to look at 401ks. You got to look at IRAs. Anything that has room, let's say like right now, the way the filing works, if you're under the age of 50, your contributions, your annual limit is right now $23,500 for 2025 if you're under 50 to a 401k. And let's say right now you go look at your year-to-date pay stub and it shows you've only contributed, I don't know, 10 grand, okay? You have another $13,500 that you can potentially put into your 401k that'll reduce your income by that amount. And that's largely for employees. Now let's shift over to employers. Let's say you're watching this right now and you have a small business or you own your own business, however you want to look at it, right? You can invoice things. A lot of my clients do this. They'll invoice things in late December to receive money in January if that works. If you're on a cash, there's a big deal. If you're on a cash basis accounting system, right? Sounds kind of weird. You're invoicing for 1 year and you're getting received the other year. The way taxes work is on something called constructive receipt, meaning you have to tangibly have received it if you're on a cash basis accounting. Those of my business owners would understand that, right?
I'm lost. Yeah, I don't.
Well,
this isn't for me. This is for those business owners, I guess.
It is. And there's different ways to accelerate expenses. There's accrual and there's cash basis. I'm not going to get into that today.
Yeah.
But are these things to consider here. There's also times to consider if you're going to have a tax bill, right? And you kind of know that because the income you made and there's some write-offs. Your CPA might talk to you about buying some equipment, right? Getting some deductions for those kind of things, some credits. These are all valid for business owners in particular. So
question.
Yes.
Now, when we're talking to defer your income, I know there's something called catch-up amounts or top-off retirement accounts. Is this part of that or is that something separate?
No, yes, it is. So that's part of that contribution limit. So what you're talking about is catch-up is if you're under age 50, $23,500 in 401k. The IRA, forgive me, it's like 7,000, I think, or 6,000. I'll get that. I always get that number mixed up. The catch-up is if you're over 50 and still working, you can do an additional, right now on the 401k is 7,500, which means you can do basically a little over $30,000 in total.
So that's kind of part of that deferring your income.
Correct.
Yeah. Okay.
And same thing with the IRA. What's the IRA limit?
It's $7,000 for those under age of 50,
Yep.
and then $8,000 for those 50.
So the
and older.
catch-up, if you're over age 50 on an IRA, is an extra $1,000. And that's, as rudimentary as that may sound, trust me when I say people will start going and look, oh, my CPA says I should buy a truck from business or do this, or I should fund my charity or whatever it is, or write to charity. It's like, well, my first question is, yeah, no, those are great. But have you looked at these buckets first?
Yeah.
That's important.
I also learned that you can preemptively pay. I think you mentioned this, but preemptively pay off your state taxes, your just certain tax bills, your property taxes for next year to get the credit for this year's.
Yeah, there's some strategy around that. You can talk to your CPA about that. You can front load some of those. You can get them update, but they're also capped out potentially.
Yeah.
So, but those are
Well, there's a lot of little things that you can prepay for the next year.
Car registrations, property taxes are all really good things to kind of talk to your CPA about.
All right off.
And you know what? Here, I'll end this first point saying this: shake the tree a little bit. Sometimes we get kind of in this autopilot with our CPAs, and it's the same W-2 coming in for you and your wife, or you and your husband, whatever it is. Shake the tree a little bit. Use this episode. Say, hey, I haven't asked this in a while. Are there any things I should be considering that you see in my tax return I can do right now? I was watching this random video, and the guy said, hey, I should be maxing out my IRA or things like that. I have a little extra cash flow. Would that help? And they can tell you how it will help you. And let me be very clear before I round out this last point, this first point here, is once January 1st happens, you can't do much from a 401k perspective anymore. Now, you are able to fund an IRA up to tax filing. That is key. So you can still get the IRA deductions, the contributions for it, up until tax filing.
I did that this year.
You did. On literally
the last day.
We get an email from Jared to our team, and my team flicks it over to me like, is this guy serious? And I'm like,
yes,
I think he is. I think he is.
But hey, Charles Schwab, I was not the only one in line doing it. So.
No, and look, you're not alone. We were busting Jared up, but you're not alone. All right, I want to move over to like my first big point to think about. It's called tax loss harvesting. This is really important, especially for those higher earners, but it's important for everybody to know. This is where you used realized losses. Realize is the key word there, to offset realized gains. Something we do here at One Capital Management very heavily. This relates to your after-tax money.
I don't think a lot of people know this one.
Some do, some don't. It depends on how experienced you are with having after-tax dollars. If you have a brokerage account, a trust account, something that's not tax deferred, meaning not IRA, we call it non-qualified, okay? What you can do is every year you can actually offset the gains you might have in there with losses. All right. So quick example, very simple. Let's say you have a 2-position portfolio. I would highly never recommend that, but let's just say that. Okay. And the total value of that, in there, one ABC stock, right, has $1 gain in it, and XYZ stock has $1 loss in it, right? Theoretically, this is a very simple analogy, right? You can sell XYZ or ABC to offset the gain in the other one, netting out to a 0 taxable gain that year. Okay, that's very simple in theory, right?
Yeah.
Now, obviously, you have to have a good investment manager on that, because just because you can harvest a loss doesn't mean it's the right move. This is my conversation about the tax bill shouldn't be the tail that wags the decision dog on whether or not you should or should not hold or sell an investment.
Because long-term and short-term are affected by this, correct?
Yes.
If you have a short-term, the taxes are different than holding on to something long-term.
Exactly. I'm particularly talking about long-term here. And long-term, just so everyone knows, is an investment you hold for more than 12 months.
Yeah.
Specifically 12 months and a day. Okay? And the reason why it's important is because if it's short-term, it goes to your ordinary income. If it's long-term, it goes to what's called capital gains. And capital gains tax is an investment tax. It's different than ordinary income.
Yeah. I always hear capital gains and I'm always like, I'm fearful. I'm like, oh, no, yeah, capital gains. That's terrible.
No, capital gains is actually a good thing.
Yeah. What is it?
So capital gains is basically a tax on your investment gains, right? So like if I bought something for $10 and it went to $12 and I sold it, I pay taxes on those $2 gains.
Okay.
So tax loss harvesting is cool. Back to that. The benefit I should say here on tax loss harvesting, to be fair, is greater if you're in a higher tax bracket, which is my point here, because capital gains is kind of capped out at much lower than, or the max cap gains is much lower of income than the highest ordinary income. So if you're in the higher tax brackets, tax loss harvesting is key.
Just be careful with wash sale rules.
Ooh. Kevin told you that one, huh?
You have an insider.
Yeah, I called my accountant yesterday. Got some tips.
But no, hey, that's good. Let's talk about it.
Yeah, wash sale rules.
What is it? Inspire me.
He doesn't know.
He's going to read it because I took notes. So you can't deduct a loss from the sale of stock or other securities if you acquire substantially identical stock or securities within 30 days before or after the sale. So essentially,
31 is a big day in the trading world.
I can't sell something to take that loss and then buy it back
immediately. Yep.
To get it back in my portfolio.
It's called a wash rule.
Yeah. This a cool little note does not apply to cryptocurrency trading.
All right. Third one I'll bring up for ways to reduce your taxable income and understand taxes to better your tax situation is itemizing. So it's really important on itemizing. And if you don't know about it, you have basically 2 options. Okay. You have the standard deduction, which is for everybody, tax filing. And to be clear on that, if you're a single filer, you automatically, out of the gate, you get a $15,750 exemption. Sorry, you get that written off your taxes right out of the gate. Okay.
Solid.
Right. If you're married, you get a $31,500 exemption.
Even better.
Or standard deduction.
Even better.
Okay.
Do I need to worry about itemizing at this point? I thought you just had to do it when you did your taxes.
Yeah. So right now, this is not so much a December 31st issue, but it is important to potentially say, because here's where it comes in. Let's say you're married filing jointly. And let's say your overall Schedule A deductions, which are things like mortgage, and there's 5 categories that this comes into, by the way, right? There is medical expenses, home mortgage interest, state and local taxes, charitable contributions, and theft and casualty. But that's usually when it has to do with like a national disaster. Like I dealt with that with Hawaii.
Fires.
Right? Fires, things like that. All right. And a lot of us in Southern California have had to deal with it. A lot of my clients have had to deal with it. We're going to be dealing with it this spring from January from the fires. I have a couple of clients we're talking. It's sad, but anyways, that's going to come up. So itemizing does play in here. Why is it important to do before December 31st? Is because if you're sitting here right now and you know you're like right at that threshold where you could do either one. However, you can create some itemization for this year and it pushes you over. You're going to get a further deduction if you continue doing that. If you don't know about it and you could have done it, this is where your CPA comes in. Also this video, right?
So
this is your
start that organization right now while you can still affect it.
Yeah.
Essentially.
Look at your charitable deductions. That's itemization, right? State and local taxes. That's the thing where you can front load some property taxes that are due in February into this year, potentially, right? Up to caps. There's just some things you can look at this year. Itemization is a sleeper. Everyone looks at it like, oh, I'll just decide when I'm filing my taxes.
Yeah.
This one's a sleeper.
Yeah.
All right. Because I think this one's big because there are things you can do, to your point. Even your question was valid, right? There's things we can do before December 31st to look at.
Oh, that's good.
That.
Don't sleep on itemizing.
Yeah.
Don't sleep on it. Mind you, those numbers I just gave you were for 2025, to be clear.
Yeah.
Okay. So that they do change every year. And the last thing I'll say on itemizing, it's a pretty simple one, but the last thing I'll say is there was new tax legislation, as a lot of us know, for 2025 for the SALT deduction, which are state and local taxes. The deduction cap went to $40,000 from $10,000. So back to our point, we now get more of some of those state and local taxes we can write off to itemize in this year.
I like SALT.
So, all right, let's talk about, I mentioned one of those things there. Let's talk about charitable giving. You should know something. I put this one in here personally because I believe in this for a lot of different reasons. This is one of the best scenarios in our tax code, as I can see it, to get that giver's high at the same time you're getting something for yourself monetarily as well.
Big end of the year, but I think we should be preaching a little more that like do this throughout the year.
Agreed.
Right.
Agreed. But remember,
this is a big end of the year. I know everyone
does it.
We do this too.
I can speak for charities that I have been involved with, 501c3s that I've been on boards of, that, yeah, cash flow, November, December is a big deal. We have to cash flow it, but it would be nice if, there was cash flow throughout the year. But, hey, we're sitting here at the end of the year. So we talked about capital gains a little bit ago, and here's the charitable comes in. This is actually an interesting note. There's a great tool here that you can do this before the end of the year, right? If you have large capital gains going on, okay? You don't have to sell them. You can actually give them to charity. So if you hold them, you can gift them. This is really key. So if you have a stock position, for example, let's say you bought it for $10,000, it's currently worth $20,000. You don't have to sell that and pay the taxes on the gains there. You can actually gift that to a charity,
and they'll get the full value of that stock.
They get the full value of the stock, and you get the full value of the amount you deducted without paying any taxes.
That's pretty good. I feel like this is maybe getting bigger, or at least maybe I'm understanding it more now.
We've talked about it at our church
Yeah.
before. I've been involved with it. These are also things called donor advised funds. You can do those as well, but you can also give directly to the church. It's a really cool way because a lot of people are like, oh man, yeah, I do have that situation, right?
Yeah.
Where like I don't have the cash per se. My disposable income isn't really great right now. I got a lot of things going out or whatever, right? But I do have these positions I've had or I inherited. For example, we've had a couple of those, right? And I do want to give, and I get the deduction for it before year end.
Before year end.
Okay, that's key. Right, that's why we're talking about this. So that one's kind of I'll call it the sleeper 2.0 within the capital gains environment.
I think that's great because if you're just selling it, basically all this money you want to give to that charity or your church, if you're selling it, you're losing a lot of what could be doing really good for people.
Yep.
So getting that full amount to the charities, I think it's awesome.
It's awesome. They get the full amount. So I mentioned this earlier, but here's kind of my two that I think work often for clients that are really important. Let's talk about Roth, though.
Roth.
This is the sneaker thing here, okay?
Roth.
Roth. What do you know about Roth?
I know that I don't have either one of these. That's what I know.
Okay. I won't go on a dissertation here, but a high level on Roth. Roth was instituted by a senator 25, 30 years ago. And the whole premise behind Roth was that we're going to be in a higher tax bracket later. And that everyone, by the way, people watching this are like, yeah, I know. We agree with that, right? We agree.
Hopefully.
Well, again, hold on. This discussion of higher tax bracket comes around the idea that it's going to be like double what we're paying right now. So I got to be candid with you. I'm not fully bought in that Roth is the end all be all for everybody. And most CPAs are going to fight me on this. Kevin might fight me on this. Every CPA I've lined up, but here's my reasoning. It's like, I would rather receive the deductions throughout my working life than hope, which is weird, hope to be paying more taxes later and then taking it out later tax-free.
Yeah.
You know what I mean?
No, me too.
It's kind of like work with the devil you know in a way.
Sure.
So
Right.
what is the difference?
The difference is a great question. The difference between a traditional IRA or traditional 401k and a Roth is, in a simple example, if I put $1 in and I'm in the 20% tax bracket, I'm really only putting 80 cents in, right? I'm getting that deduction. If in a Roth, I put $1 in, I'm putting a full dollar in, I'm not getting a tax deduction for it now, but later when I pull those dollars out, I'm not paying tax on them later. And in a traditional, I am. So I'm getting a deduction now, but when I pull it out, I'm paying ordinary income taxes at that point. Does that make sense? Think of it like a tug of rope. You're either getting a deduction now or later, or you're either getting a deduction now or paying the taxes versus not paying the taxes. So it's kind of pushing the can down the road. Having said all that, I do actually believe that having Roth in your overall retirement plan is a good thing. I just don't think you need to overweight it in there.
Yeah.
Okay. There is something I want to bring up here that has worked for some of my clients. It is interesting. It's called the backdoor Roth. You heard of this?
Nope.
All right. So if you exceed the income limits for contributing directly to a Roth IRA, because there are limits for that, okay, you can use a backdoor Roth, where essentially what you do is you fund an IRA, a non-deductible IRA, okay, which is just an IRA, you can't take deduction for it, right? And then what you do is you convert it to a Roth. This is a way to get around income limits, and it's a way to kind of say, hey, I'm making too much money. I exhausted all the things. I went through all your steps, Brad. I maxed out all my retirement plans. You know, I did everything I could, right? I still want to get money into a Roth, but I make too much money, for example, right? And this happens a lot because the income limits between, I don't know what it is, 150 to 200. It's not crazy high. It's high, but it's not crazy high, right? So this limit affects a lot of people. You know what I mean? So what's interesting about that is you can now do this and still get money into Roth this way. So that's a really key way to reduce your tax bill later. And you got to kind of look at that this year for next year and then every year kind of thing.
Good tip.
Solid.
I feel like I'm losing you a little bit here.
No, we're good.
Is that accurate?
There's moments of lost and then moments of found and then lost.
What is
again.
your greatest takeaway thus far, Kira?
My greatest takeaway? Well, I did got tax help for the first time last year. So this is all very new.
Okay.
And I feel
That's
like a
why I'm
lot of
asking
this
you
just doesn't
particularly.
apply to me because I don't have an IRA. Maybe charitable giving. I actually did learn that when you donate like to Goodwill and stuff like that, that's a tax
It
deduction.
is. They give you a little receipt. They have the pads there.
I started saving those.
See? Start saving those. Now you should know when you talk to your CPA, there is limits to how much you can deduct. I won't go into those right now, but you can't deduct everything. You know what I mean? Or all of it.
Yeah.
There is limits. Okay. But yeah, it's good to know.
I was surprised how many things are write-offs though. So
we talked about itemization. I know it sounds simple, but make sure that you max out your retirement plans if you have the disposable income. Tax loss harvesting is huge, and gifting for charity.
Charity's big.
Charity's huge, and you have to do all these things I mentioned, other than funding the IRA. All this has to be done before December 31st.
Yeah.
Okay? So if you're thinking about it now, you're like, oh, I'll deal with it then. You can't. Once December 31st hits, you're donezo.
You're done. You're reactive, not proactive.
So those are all my points for today. Anything you guys want to add to this?
No, I think you did a great job.
Ooh.
don't postpone your taxes.
Don't postpone your taxes. Get after it. Hey, last thing I'll say. Tax planning is very proactive, not reactive. And I would say 99% of people treat it like it's reactive. Oh, I'll deal with it in April or February when I get my W-2s.
For sure.
Right? Fine. I get that. But yeah, it's most people, right? So don't be Jared. Don't be producer Jared. And I get an email from you on tax filing.
We've said that a lot.
Fund this.
We've said that a lot this
So
year.
a couple times this year.
Yeah. I'm fine with that.
Oh,
Poor
you're
Jared.
a great guy.
Poor
Thanks.
Jared.
Thanks.
Hey guys, we appreciate you always. I hope that helped you guys. As always, thank you to our subscribers. And if you're new to our channel, we come out with things every week. We're happy to receive comments and messages. You can reach out to us on our YouTube channel here or on our socials at Mindset with Brad Barrett. And as always, until next week, if you lead with love, it's going to be all right. See you guys. I got a tax joke for you.
Oh,
Okay.
gosh.
It's not so much a joke as a quip, as a saying.
A quip.
Okay.
You know why they call it gross income? Because it's gross. What you see is going to taxes.
We'll cut that one out.
Yeah, it's bad. I would cut that one out. The delivery wasn't great.
That's fine. We'll work on that.
It is gross.
Yes, it is.
So what you made-
It really is gross, yes.
It's ironic that they call it gross. That's
Yeah.
what I'm trying to say. It was funny in my nerd circle.
Mm.